When RSI drops below 30, many traders immediately think the market is oversold. It's time to buy. But here is the problem. RSI only looks at price momentum. It does not know if buyers are stepping in or if sellers are still pushing the market lower. So what happens when we add one more piece of information? The shape of the current candle. Today, we are going to open up RSI Market Structure Zones Pro and see what this script really does. The source code credits Forex Market Insights. This is an indicator, not an automatic trading strategy. It does not place trades, and it does not prove that the signals make money. What it does is simple. It shows RSI, checks the candle shape, looks for some divergences, and sends alerts when the conditions line up. That is the right way to look at it, as a chart tool for observation and testing. Let's start with the RSI. The script uses the normal trading view RSI based on closing prices. The default length is 14 bars. So the RSI math itself has not been changed. This is an important point. The script does not make RSI read the candle. It calculates a normal RSI first, then adds a separate candle filter around it. The RSI line turns green when it is higher than the previous bar. It turns red when it is not rising. This is easy to read, but it is only a quick momentum view. It is not a full trend detector. Next, the script adds 4 custom RSI levels. 80 is called overbought. 68 is called resistance. 35 is called support. And 20 is called oversold. These levels are not the standard 70 and 30. They are simply the levels chosen by this script. There is no backtest in the code showing that 68 or 35 is automatically better. There is also a 3-point tolerance around the middle levels. In practice, RSI at 38 or lower can count as near support. RSI at 65 or higher can count as near resistance. So these are not 4 clean, separate zones. The support condition can overlap with oversold, and the resistance condition can overlap with overbought. Now we get to the most useful teaching part of the code, the candle filter. For a strong bullish candle, the script checks 3 things. First, is the candle green? In other words, did it close above the open? Second, is the candle body bigger than 60% of the full high to low range? Third, is the close in the top 30% of the candle? If all 3 answers are yes, the script calls it a strong bullish candle. The bearish version does the opposite. It looks for a red candle, a body larger than 60% of the range, and a close in the bottom 30%. This is a clear price action filter, but let's keep the claim realistic. A strong green candle tells us that buyers were strong on that bar. It does not prove a market reversal. It can also be a short bounce inside a larger downtrend. The script now combines the 2 parts. Near support plus a strong bullish candle creates a support reaction, RSI in the oversold area, plus a strong bullish candle creates an oversold reaction. The bearish reactions use the same idea, near resistance, and overbought. For a bullish signal, the script also wants RSI to be rising. For a bearish signal, RSI only needs to be not rising. This means the script is not buying simply because RSI is low. It waits for a strong candle and a matching RSI direction. But there is an important limitation. These are live conditions on each bar. If several bars qualify, the signal can stay true for several bars. That can create repeated alerts instead of one clean signal. And here is a real code issue. The script has show by signals and show sell signals switches, but it never draws those signals. Only the divergence triangles are plotted. So a big buy marker shown in the video would need to be added to the code or shown as a separate illustration. The script also looks for divergence. Bullish divergence means price makes a lower low, while RSI makes a higher low. Bearish divergence means price makes a higher high, while RSI makes a lower high. The default pivot settings use 5 bars on the left and 5 on the right. A pivot becomes known only after 5 bars have formed to its right. At confirmation, the code uses offset pivot right bars to draw the triangle back on the old turning point. That makes the chart easier to read, but it can also look like the signal appeared earlier than it really did. So the honest explanation is, this is a confirmed divergence, displayed at the location of the old pivot, if required divergence for signal is turned on. Only the alert signal becomes stricter. The divergence is confirmed several bars after the pivot, while the candle reaction is checked on the confirmation bar. The zone background can still highlight without a divergence. Also, show divergence markers only hides the triangles. It does not turn off the divergence calculation or its alerts. At this point, we can describe the indicator in one sentence. It is a normal RSI with custom levels, a strong candle filter, optional divergence, and alerts. It does not check volume or volatility. It also does not map break of structure, higher highs, or lower lows like a full market structure tool. So how should a trader observe this tool? First, watch what price is doing. Second, check the RSI level. Third, wait for the candle filter. Fourth, treat divergence as optional confirmation, not as a prediction. Finally, check the bigger trend and your risk plan. For example, if RSI is at 36 and a strong bullish candle appears, the script can highlight an RSI support reaction. Why? Because this code treats RSI at 38 or lower as near its RSI support threshold. That highlight does not mean buy now. It means this bar matches the conditions we decided to watch. The trade decision still needs context, an entry plan, a stop, and a test on historical data. Now for the score. The RSI colors, levels, and background highlights are clean. The score loses points because the buy and sell display switches are not connected to buy and sell shapes. The candle functions are easy to follow, but the support and resistance conditions overlap with the extreme zones and signals can repeat. It may be useful as a filter, but there is no strategy backtest and no proof that the fixed levels work better across markets. It is a good example for learning RSI conditions, candle math, pivot confirmation, and alerts. About 7 out of 10 as an educational chart indicator. The main lesson is simple. RSI can tell us that momentum is weak or strong. A candle filter can tell us that buyers or sellers were strong on one specific bar. Divergence can show a difference between price and momentum. But none of these pieces by themselves guarantees a reversal. This indicator is best viewed as a learning tool and a way to organize chart conditions. It is not a complete market structure engine. It is not true multi-timeframe analysis, and it is not proof of a profitable strategy. Use it to ask better questions, test the rules, and understand what the chart is showing. If you enjoyed this teardown, subscribe and comment which script we should review next. We decode trading tools beyond the signals. See you in the next one.